we have greatly reduced our exposure in Saudi. We do understand there is this MSCI event which is going to be like 7 billion. We have a FTSE event as well next month, which will drive around 2 billion. But Tadawul is expensive, incredibly expensive. You're talking about 20 times earnings, and earnings trajectory is going to be weak, at least for the big weights like the banks and the petchems. And if you were to look at it, it's going to be very difficult for the market to push itself beyond this point, in our view. We are churning more into the second-tier names, the consumer space, the insurance space, and not the heavyweights, actually.
And the banking sector. It's going to be really interesting going forward, isn't it? Because especially with what you have at the moment with the Fed, and then at the counterpoint, of course, is the lower oil prices and the trajectory for continued lower oil prices. Correct. Not great for the Saudi market, and certainly not for the private sector in Saudi Arabia, which so many in the government are hoping will be galvanized by what's happening in the market. So it seems as if it's a vicious cycle.
It is, actually. I mean, banking sector earnings is going to be weak. We're talking about a 10% earnings impact to the banking sector if you kind of taken a 50 basis points of Fed rate cuts. There are some green shoots as far as the macroeconomic is concerned. You have a non-oil GDP which is firming up, consumer spending is looking good. Credit to public sector is good as well, but the most important, the missing component is an absence of corporate lending. We haven't started seeing the private sector spending or investments kicking in, hoping that a lower interest rate environment will eventually lead them to start doing much more of investments in the most expected, the NEOM projects, the Red Sea tourism development projects. All of these are still in the design phase and the planning phase.
I got some recent pictures of NEOM, and there ain't much to see yet. Matt has a question out in Singapore.
Yeah, hi Aarthi. How do you play the Middle Eastern markets at the moment in this world where we are seeing central banks appearing more and more dovish, perhaps not so much the Fed as what we were anticipating, and also the trade war front as well?
Aarthi, I'm going to give you that question because I don't think you can quite hear what Matt has to say. But in terms of the trade war and the Fed at this point, when we look at the Middle East markets more broadly, Kuwait looks exciting to you guys. My question would be, though, on UAE specifically, how much does this actually benefit the UAE in terms of that obvious connection between being a dollar-denominated economy, but then also the worries about global growth?
As far as UAE is concerned, I mean, UAE is a bit vulnerable to trade wars. I mean, increasing signs of these kind of trade wars will impact, it has a negative impact to pretty much the equity markets in the region. Dubai and UAE is slightly bit more vulnerable because of the international, the increased importance of international investors, not just with the financial market, but even beyond the financial market. Look at the real estate, look at the tourism. There's a lot of foreign money in this country. So it becomes more vulnerable if there is something with respect to trade wars or global meltdowns. It becomes the most impacted stock exchange in the GCC. But having said that, Dubai has a lot of low-hanging fruits. We are positive on UAE markets. We are churning more into UAE blue chip names on banks, on real estate, on consumer stories, hospitality, cheap valuations, very supportive dividend yield, tons of regulatory measures by the government, which is giving a lot of positive investor sentiments and push.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.